Welcome to the weekly video update, where I'll go over the action in the market for the week of December 11th through the 15th, and then we'll see how things look for the week of December 18th through the 22nd. We had another pretty solid up week. In fact, we've had a number of up weeks in a row now. Things are turning much more positive. We're also in a period of positive seasonality, which is turning things more positive too. That's kind of a self-fulfilling prophecy. But when you look at the daily charts, both in the short and intermediate term, we are well overextended to the upside. Doesn't mean we can't go higher. We would just become more overextended to the upside. There's also this possibility, maybe, that if the market was to go sideways for a little bit, it could consolidate or work off some of that overextended to the upside condition or overbought condition. But at some point, folks are going to want to come in and take some profits. We've seen a really solid up movement in the market since the October low that we hit, and it just makes sense. People want to lock in those profits at some point, and it might actually turn into more of a decline. If that ends up happening, we'll be evaluating that to see, are we just pulling back at some point, or are we turning more negative? But when you look at all of the charts right now, things are remaining positive. Before I get started, please know that I am planning on doing a new type of video in 2024 that will be in addition to the videos that I post now, where I just take a chart, maybe 1, 2, or 3 on a particular topic. Usually it'll be anywhere 8 to 10 to 12 minutes long as far as the video is concerned. I know that these videos are longer than most other videos, and I show a lot more information than other people show. That's all by design. That's what works. That's what has been successful for decades as I've analyzed and learned more and more about the markets. Well, I just want to take some things that I run across or things that are really talking right now to us and just doing a short video. Now, mainly this is to help introduce people to what I do with the hope that they'll gravitate over then to the longer form of the videos, because I feel that's where you get the best amount of information. So be looking for that at the beginning of 2024. Also, with every video that I upload, there is a PDF that I make available. It's in the description below each video, whether it's on YouTube or Rumble. You can see the same slides that I'm looking at right now. You can look at the charts that I go through. Some people find that very helpful. Also, please be reminded that every day I update on the community tab on the YouTube channel. I can't really do this on Rumble. There are a thing called pivot points, and there are intraday pivot points, which really tend to be quite accurate, both for support and resistance for that particular day, and then they recalculate for the next day. Well, there's also other pivot points that last for the entire month, and I update that chart just to include the most recent price action that we're seeing in the S&P. This is something that I rely on heavily, and that's why I wanted to go ahead and post these on the community tab. I do have a private Facebook group that you're welcome to join. Not an awful lot of activity going on. Seeing a few new members and having a little bit of back and forth, but if you want to become involved in that, please let me know. I will gladly invite you into the group, or just send me a request and I'll allow you into that. I have already posted the poll for the upcoming week, and I'll be going over the most recent poll here in just a moment. I do really watch comments, not only just on YouTube, but also on Rumble. I get rid of the crap comments as soon as possible, and I've had a lot more on both channels lately, and they're either put there by bots or they have nothing to do with anything that we're talking about in the videos. I want a lot of comments. I want people to feel like they can contribute something if they want to. Now, if you want to stay more private, you're welcome to send me an email. I put an email at the end of each video. If you don't want other people to necessarily be involved in what you're commenting on, feel free to do that. It means it's more of a one-on-one type of situation. But if you want to post a comment, even if you disagree, even if you reach a different conclusion, that's fine. That's not what I'm coming up against. What I want are legitimate comments that are posted on both channels. I also post on Rumble, and here is the link to that. It's also in the description below. I know some folks prefer YouTube, other folks prefer Rumble. I decided just to go ahead and post on both. All right, let's go back and talk about this past week's session. So for the week, we were up 2.49% for the S&P on above average volume. Now, some of that, we were above average for most of the week, but we saw a really big spike up on Friday, and that was because of quadruple witching. We had a lot of options expiring and a lot of position jockeying going around as that all works itself out. And then the S&P 500 as well as the NASDAQ 100 did rebalance on Friday, and that involves some buying and selling as well, and also contributes to a lot higher volume. We are positive now. We have some extreme positive conditions as I go through the charts that I'll show you. We are really extreme in the short and intermediate term, and even a little bit in the long term on the daily charts. So we're getting a little overextended there. Doesn't mean we have to stop, but it's just something that we want to be aware of. We possibly saw a Fed pivot this past week. Finally, after a year and a half, the markets have been anticipating this and putting out scenario after scenario that maybe they're done raising rates. Maybe they're going to be able to cut rates at some point. It seemed like we had something more definitive this past week. Now, that could always change if the economic reports coming out just really show a lot of strength and that inflation is starting to become a problem again. That could all change. We can only go with what we're being presented with right now, and then we just adjust as new information is added to the overall story. We're also keeping an eye on all the different geopolitical events. Sometimes something can happen and it will end up having some kind of an impact on the markets. And then we did have the Fed come out this past week, and then after that, they didn't change rates, but after that, there was a press conference by Chairperson Powell. And then you have the FOMC, which also means Federal Open Mouth Committee. You have some of these folks doing interviews or some kind of writing an article or something happening, and they say something, and then it might contradict what Chairperson Powell said, and someone else may confirm what was already said. And that's part of the game that goes on as we try to disseminate all this information. Our trend right now, we're just getting ready to cross over the moving average. So we're still below 20. That's why I have the weakening trend here, but we are crossing above the moving average, and it is positive. So if you're more aggressive with the ADX, you see a new trend developing longer term now. If you're more conservative, you might want to wait until that ADX actually crosses above 20, and I'll show you that chart. So looking at the week, the Dow, which set a new all-time high both on Thursday and Friday, it was up 2.9% for the week. The NASDAQ was up 2.8%. The S&P itself was up 2.5%. But what is encouraging right now, we have this possible thing called the January effect, which usually sees more favor going to small cap stocks, and that's the Russell 2000. It can also go over into the mid caps as well. And we're wondering, okay, they had a really good week. Small caps were up 5.5%. Is this going to continue? Because we've been faked out over the last month or two, actually for the last couple of years, where it seems like the small caps go up really nice and it looks like things are shifting more positive, and then they spend the next number of days either going sideways, if not actually giving back all of the gains that they just acquired. So, once bitten, twice shy kind of a thing. So you have some folks that are a little apprehensive about that, but things are improving even in that area with the small caps. So here are some bullet points. The Dow closed at a new record high on Friday. It also closed on one on Thursday. The S&P was able to close above 4,700. Friday's close marked the seventh, there should be a TH there, or 7 consecutive winning weeks for the major indexes, or if you want to do it the UK way, indices. The FOMC did vote to leave rates unchanged. They're currently at 5.25 to 5.5. That was not a surprise. That's what the market was anticipating. Then they come out with this thing that's becoming more prevalent than it used to be, called the Summary of Economic Projections. And now that's another bit of information that the market can take and really start to dive into and try to come up with some secret meanings. Well, in this report, it showed improved growth, at least for the outlook for 2023. It also is projecting that there will be lower inflation in 2023 and 2024, and that there'll possibly be up to 3 rate cuts. Now, it might drop down to 2, it might go up to 4. This is just what they're saying right now. The market really latched onto this, and this is what they're using as justification for the Fed turning from being more hawkish to now going to a more dovish stance, which is more market friendly, at least for a while. And then other central banks also met this past week, and they decided to leave their rates unchanged. This was included the European Central Bank, so the whole EU, the Bank of England, the Swiss National Bank, and then the Hong Kong Monetary Authority. Interest rates and the US dollar index declined. That's typically what will happen when we see stocks going up. We'll see weaker, the dollar going down compared to other currencies. We'll also see interest rates starting to fall. And if the Fed is possibly getting ready to cut rates, it only stands to reason that we would see interest rates in the market also start to fall. The S&P equal weight ETF, this has been a concern. For most of 2023, we've been seeing the mega caps really doing well, and that's what has really held up the market. That's fine if you do things like I do, where I just follow the S&P 500 and do all my strategies around that. But if you invest in individual stocks, you might be very frustrated. Well, we could potentially start to see that changing now. The equal weight showed a lot of improvement this past week. We're not seeing, I mean, the mega caps had a good week, but not as good as other weeks where the equal weight index is showing a lot of improvement. And I'll show you a chart of that. Most of the economic data that came out feeds into this idea that we're going to have a soft landing, where we're going through a period of economic weakness without going into a recession. The market seems to have latched onto that now for the last number of months. It had it about a year ago, then it went away, then it came back, and there's this debate going back and forth of whether that was actually going to happen. It seems to be more in line now of this soft landing approach or narrative that may actually end up playing out. The CPI came out, that's the big inflation report, and it was mostly in line with what the market expected. The PPI actually went down a little bit and is showing some disinflation, which at this point is not necessarily a bad thing. If it keeps going, yeah, that could turn into a bad thing. But right now it was taken as positive. Retail sales were still pretty healthy. They actually rebounded from the previous month. And the weekly jobless claims, even though they're coming down a bit, they're still above, or excuse me, they're still below where we are usually at when we go into recession. So taking all of this together, it was pretty positive on the economic report front. Then Friday did see huge volume because it was quadruple witching, as well as the rebalancing that I mentioned for the S&P and the NASDAQ 100. So we also had some Fed speak that came out. The major one was the press conference when Fed Chair Powell said that the FOMC did discuss when it will become appropriate to begin dialing back its policy restraint. Oh man, you couldn't have asked for a better Christmas present for the markets. Now, at some point, this also becomes a nightmare, but right now we're switching possibly from a hawkish Fed more over to a dovish Fed. But now the debate's going to be, when is that going to happen? But then, not to be outdone, actually, he was already outdone because Chair Powell is the Fed chairperson. The New York Fed President Williams, who is an FOMC voter, said that the Fed isn't really talking about rate cuts right now, and that it is premature to think about the timing of rate cuts. Okay, it's not necessarily what Fed Chair Powell said. The market wasn't really quite sure how to take that. But then, not to be outdone even again, Atlanta Fed President Bostic, who will be a voter in 2024, expects 2 rate cuts in 2024, starting in the second half of the year. Okay, so that's some rate cuts. At least they're saying stuff like that now. But the market's already thinking about March and into May and into July. And I have some charts to show you that. And that's going to be the game that's going to start to play now. Are we going to have rate cuts? If so, when? Here's the VIX taking the average from 1990 up to 2022, where I've dropped the circle down here because we're getting really low with the VIX. As we've been going up, the VIX has been dropping. So we're kind of even well below the average readings that we've been seeing historically. We also want to keep an eye on this. This hasn't been updated since the end of June, but this compares 1966 through 1982 with the current climate. And we've been sticking pretty much with this blue line here. The gold line could be extended down. That's great if we're actually showing a real decrease in inflation. But look at what happens after this. This is the late 70s when we hit hyperinflation, where it was stagflation. We saw really high inflation without any economic growth, and that really did a lot of damage to the economy before it started coming down in the early to mid 80s. We don't know if it's going to play out that way this time. We can't project this too far ahead. I mean, people try to do that, but my goodness, it's like predicting the weather 6 months from now at a certain day and a certain time. You can do it, but how likely are you going to be correct? All right, now I'm only going to start showing this chart in the weekly video because we've dropped down below the 4.02% for the 10-year yield. This is a RenMac chart that I found on Twitter. And when we were above this 4.02% level, that, at least according to their research, we bite into corporate profits. All right. Now we've dropped down below that. So I'm going to look at this every day, and I follow the 10-year yield very closely. And if we start to go back up, I'll start showing this chart again in the daily videos. But for right now, as long as we're under that level, I'm just going to show this in the weekly videos. Here are the poll results. This is the poll as of December 15th. But remember, the questions were asked a week ago. And I asked kind of a similar question this week. I do have the new poll that's already been posted. Do you feel the January effect will occur this year? 63% said yes, where 38% said no. Right now, it seems to be playing out. We don't know where we're going to go from here, but at least up to this point, it's looking pretty good. Then the markets, and I like how I put that S a little after the word there, have been chopping sideways, and we were already in overbought condition, and now we go up and we're even in a more overbought condition. But we've been in a sideways range for over the last few weeks. This was a week ago. Over the coming week, do you feel that this will continue or either lead to a breakout or a breakdown? 50% thought that we will break to the upside, and that's what happened. Now, there's a little bit of discrepancy here because if you see the bottom one stay within the recent range, we've really been able to break above that for right now. And then 29% thought that we were going to break to the downside. So the folks that chose this, that's what ended up happening. As of the close a week ago, the S&P is back to the July 31st high. Now, this is before we had this week. Do you feel that this will act as resistance? And it kind of did there for a while. And 62% said yes, but we're now above that. We've now been able to break above that July 31st high, and 38% thought that we would not. Seasonality, and I kind of reworded the question in this week's poll, for the rest of 2023 is positive based on historical averages and patterns. Do you feel that we will continue to follow this pattern or end up deviating? This is the one where I put in a little more ambiguous kind of an answer here. Follow historical norms, 55%, and so far that's what we're doing. Deviate to the positive, which means we're going to even break above that, and we're kind of doing that, but only 18% at least thought that's what's going to happen. Now, we could stall out here, we could pull back from current levels, but right now we're actually exceeding historical norms, or we're going to deviate by looking more negative. 27% thought that's what would happen. So you're kind of in the number one and number two category here, at least as far as what really ended up playing out. Then I update this every week. This is just showing the justification for stock prices to go higher, because no matter what we look at, earnings do continue to go up going out into the future. The market likes that. And when we start to actually move higher, they like to push prices higher. We had a number of different posts from FactSet. It's looking at the earnings preview. Now we're starting to look ahead into 2024. Analysts are expecting double-digit earnings growth, and we're over here, way over on the right-hand side. This is what they're projecting for right now. Now, these are going to change over a period of time, but they are remaining quite optimistic looking forward. Then here's another one just showing for the year 2023, and we're even going to go up in 2024. Even looking more positive from an earnings perspective. Then their other post says, where are analysts most optimistic on ratings for S&P 500 companies heading into 2024? I have to go through some of this ambiguous writing here. I won't read all of it, but there are 11,319 ratings on stocks. That's what stock analysts do. 54.9% of these are buy ratings and 39.7% are hold ratings. Now, you want to get my take on analyst projections? I do have a video in the free class that's on the YouTube channel where I talk about these things. I won't go into it here, but I'm not a real big fan of this. But if you look at most of, at least in CNBC, when I used to watch it, I don't watch any financial media anymore. It's useless in my opinion. But these guys would come on and these would be analysts and they would say it's a buy signal or a sell signal or a hold signal. But most of the time they're buy signals. And they want to stay in good with the companies that they get information from. So yeah, they're going to recommend their stock. Where 5.3% are sell ratings. You have to be pretty bad to get a sell rating. And down here on the bottom, this is just showing how the buy ratings have been changing recently. They've actually declined a little bit, but they're still well outnumbering any of the sell signals. Then getting into our charts, here's the intraday chart based on 10 minutes going back to Monday, where we had a little bit of an upward move in Monday's session. We did go up a little bit in Tuesday's session. This was leading up ahead of the Fed making their announcement. Here is what happened before the Fed made their announcement. And then boom, right when the announcement was made and then the press conference, that's when we really started to skyrocket up. We ended up actually gapping higher on Thursday, but then giving a lot of that back during the session. And then we were just flat as a pancake in Friday's session, even though it was quadruple witching. So for the week, and this is just the 5 trading days on the week, the S&P was up the most. We don't see this here I'm sorry, the small caps were up the most. We don't see this very often. So this is kind of a nice thing to be seeing lately, followed by the mid caps, where all of the indexes ended up being up, where the NYSE and the S&P were up, but up the least, just for the 5 trading days. So going back to the beginning of the year, all of the indexes are now positive, with the NASDAQ and NASDAQ 100 doing the best, followed by the S&P. Then when we go back to the all-time high, we haven't seen this in a long, long time, where we actually have the NASDAQ 100 and the Dow. They're actually turning positive when we compare it to the all-time high for the S&P 500. And we're 1.55% away right now from that all-time high for the S&P. Now, be aware, if we do get up to that, that's probably going to be some major overhead resistance. So it's going to take some real power to be able to break through that. But now the question is there. Do you think we're going to hit a new all-time high by the end of 2023? Do you think it's going to come in 2024? Do you think it's even going to come at all? Do you think we're going to turn and go back down from here? These are the things that we have to ask ourselves every day. Way over on the right-hand side, we still have small caps, which are down the most since the all-time high, but they've really been making a comeback. Looking at our sectors, this is for the week where we had real estate, materials, and industrials. These have been really out of favor in 2023. They had a really good week. Discretionary, which had been stronger earlier in the year and then over the summer really turned weak, it's now starting to make a bit of a comeback. The financial sector is looking a lot better. The tech sector, which has been a real champion in 2023, it was also up, but it's more in the middle right now. Energy even went up. And when you look at all of these, communication, which has been another stronger area, it was up too, but up the least. So we're seeing more broad participation and some of the other areas starting to come in and take over and possibly showing some leadership. So when we look at our relative rotation graph, energy, which had been doing well, it's now showing more weakness. And that's why it's turning yellow and going down. Communication had been a stronger area. That's pulling back. Now, this is looking over the last year. When we look at tech, this is still one of the stronger areas. And financials, did you think they would ever get positive again after the bank crisis that we had last March? They're finally seeing a little bit of love. Some of the weaker areas are discretionary down here, which was stronger earlier in the year. And then we have the healthcare. That's another more value play. That still continues to be weak. But we're seeing some improvement with the utilities, real estate, even with staples and industrials. So when these are all moving up, that typically means you're seeing more broad market participation. Now, looking at the sectors just for the week, real estate, materials, they were up the most, followed by discretionary, which finally had a good week, where we saw things like healthcare, staples, and utilities down on the week. And again, this is just the 5 trading days, Monday through Friday. Going back to the beginning of the year, we still have tech, communication, and discretionary doing the best, where the other sectors, even though they're showing some improvement, are down year to date. Going back to the all-time high, we have energy still in the first place here, followed by tech, industrials, and then all of the other sectors continue to be negative. Looking at sentiment, we did tick up a little bit. We're currently at 67. When we get above 75, that's when we start to get extreme. And we almost got up to that level this past week, but then we pulled back down. So we're not necessarily getting an extreme reading here. We are getting lots of overbought indications on our other indicators that we use. It would be more confirmed if this was to go back above 75, and that would really give us a louder signal about the possibility of a pullback or at least going sideways. Here's the active asset managers where they ticked up just a little bit and they're not necessarily extreme positive now. Here's the actual number coming in at 77.97. We take a little bit of note of this when it gets above 80, but we really start to notice when it goes up to 90, and we're like screaming at this when it gets up to 100. Here is the VIX, where we continue to really trail off, both with the line chart, and we're getting really low levels on the VIX with the bar chart. The Ulcer Index, we're pegged at the bottom on the daily chart. We're dropping below the moving average here on the weekly chart. And we tick back up because you have RIDEX, folks. These are mutual funds. And this is going back up just a little bit. But this is as of Thursday. So we're actually spiking up a little bit here, which is usually a little bit contrary. We tend to see this going down when the market really goes up. Then looking at the latest reading from the American Association of Individual Investors, we're starting to get a little extreme here. We could still go higher, but that's another sentiment indicator that we follow. We're also seeing this really positive here with the black line declining. That means the tech sector is outperforming cash. Keeping an eye on some economic conditions here, we have the GDP now put out by the Atlanta Fed. We're coming in a little bit over 1% right now, looking forward, where the different forecasts are anywhere from 1 3/4 to about 0.75%. And I think I misspoke a week ago. I think I said it was negative. We're actually positive with all of the forecasts currently. This is looking at it on a bar chart, and we're starting to look more at the fourth quarter. We're getting another estimate this week, the third estimate for GDP. That probably won't be a market mover unless it comes in drastically different than the first two that we received. And then we're still continuing to decline here. When we look at risky bonds versus not as risky bonds, this would be going up if we were getting ready to have some problems. We are declining with our Chicago Financial Conditions Index. This works kind of opposite. If this was going up, that would make us concerned. The fact that this is going down and below the black line, that's positive. And this is the reading well over a month ago now on the tightening conditions, where they are lessening those a little bit for the banking sector. And we did get an updated version of the real-time SOM rule recession indicator. It's coming up, but we're not up to the red line yet. If we get up to this red line, that would be a concern. And there was a lot of back and forth on Twitter when this came out, that there is some concern, and they're wondering, can we really trust it this time? My problem is not the charts and not the data. It's that this data sometimes is so delayed that it doesn't really help us right now, because some of these charts only update once a month. And if you're trying to make some decisions and you're waiting around for weeks just to see something updated, you could really suffer the consequences. This was also updated on December 1st. This is the smooth recession probabilities chart. We are above the black line, but we're not up to the red line. We get concerned if we go up to the red line. Then the Brave Butters Kelly Index, it was actually updated here, where it actually is coming down just a little bit after it had been going up. Inflation, we're going to get another key report with the PCE inflation coming out on Friday. We are starting to decline now as far as how they're looking at inflation going forward. This adjusts every day. Then looking at the Fed, and I have a little bit of a different take if you've watched any of the other videos. We take the past meeting, that's off the table now. That's history. So now we're looking at the next meeting, which will be on January 31st. And right now there's an 89.7% chance that they're not going to raise interest rates. This range that you see here is where interest rates are at right now. And then we can look at see how this has changed. It actually has come down just a little bit when we look at the current reading a day ago, a week ago, and a month ago. Now I'm starting to go further out, and I usually don't do this, but since the market is talking about, are we going to cut rates going forward? And this is going to change every day. This will change. Right now, there's a 62.7% chance that they're going to cut rates 25 basis points. Now, by the time we actually get to this meeting on March 20th, yeah, a lot of things are going to happen between now and then. And then we look out to the May 1st meeting where we're seeing more across the board. Some people think we're going to cut them even more. Some people think we're going to only cut them a little bit. Others still think that we're going to leave them unchanged. Some think we're really going to go crazy and cut them massively. Anything can happen at this point. And then we look out to the June 12th meeting where we're also seeing a lot of figures across the board right now. We are still seeing how the Fed's balance sheet is continuing to decrease. And then when we look at this on a year-over-year basis, it is still going down as their assets are falling off the balance sheet. Then looking at breadth, we are seeing a real improvement, and we're looking positive based on price and volume on the weekly chart. We are continuing to go up with the new highs. We're rolling over a little bit with our 4-week moving average, but we haven't quite crossed over negative. When we look at the 10-week moving average, we're still going up. The advanced decline ratio did turn down a little bit, but we're still above 0. That is still positive, though. Accumulation distribution, which is another smart money indicator, continues to be above an advancing moving average, and we're seeing the same reading on the daily charts. Then looking at our trend, where we're just barely starting to cross above the moving average. If you're more conservative, you're not convinced yet. If you're more aggressive, you're like, whoa, wait a minute. And the green line's on top. I have now just turned positive as far as the trend. And I use these charts for the number of different strategies that I implement, because I implement different strategies when we're trending, when we're not trending. If it looks like we're kind of trending, I use the green and the red lines to help me determine what to do for those different strategies. With the Erin indicator, we are turning back more positive. We're above 0 because the green line is on top here and the red line is declining. With the mass index, we're not getting a signal right now. Looking at the daily chart, we were able to get above this previous resistance. So we got above this previous shorter term high here, but then we got back above this other high that was set back in 2022, and we're currently above this pivot point right now. So we're still above shorter term support. On the bottom, you can see where volume just really spiked up. We're getting even further away from the midpoint on our trend channel going back to 2009. That is positive. And this was the resistance level that we hit last summer. We came right up to that and then started to go down. We've now come back up to it, and it kind of gave us a little bit of a problem there for a while, but now we've been breaking above this. The next big one is we're actually a little bit above this high right here. Now we might have to see, are we going to go back and test the all-time high for the S&P 500? So, but when we look at it on a trending basis, we are still positive. We're above the moving average, and the moving average is going up. We're also in a positive longer-term trend when we look at a shorter-term moving average above the longer-term moving average. We had been extreme with the McClellan oscillator, but we actually ticked down and just barely budged back up this past week. We're getting extreme with the summation index based on price and volume. This is even longer term. We can still go higher from here, and even if we get up here, we can dance around here for a while, but this is just something to be aware of. When we look at the Swenlin trading oscillator, we're looking more positive based on price and volume and not extreme. We are getting extreme with the bullish percent index, and we're seeing the same thing on the daily chart. When we come up and spike and start to come down, now we might chop around for a little while, but when we fall below 70, that's when an official sell signal will be generated, but it might take some time for that to play out, or it could happen in Monday's session. We'll have to see. Looking at the PMO, we are looking better with the momentum oscillators here. We're turning back up. We're getting extreme based on price. We're still looking pretty good based on volume and not necessarily extreme. When we look at our PMO studies, we're going back up and looking positive with the PMOs that are rising. We're turning back up with the buy signals, but we're looking extreme with the PMOs that are above 0. This is something too. We spent a couple of days now outside of the upper Bollinger Band. So we're seeing this on the daily chart. It's also being confirmed here on the weekly chart. We don't spend very much time above or below a Bollinger Band, and we spent at least 2 days, maybe 3, above that level now, and something's going to have to happen here. Either price is going to have to come down, or the blue line is going to have to go up, or some combination of the two. But when we look at our momentum, we're looking pretty positive right now with our short-term oscillators. We're also turning back positive with our intermediate-term oscillators. We're turning up and showing improvement with our longer-term oscillators. And we're seeing kind of that same thing on the daily charts. The KST is the one lone holdout on the daily charts to turn back positive. The chicken money flow is still showing that the big smart money is continuing to buy. The Chaikin oscillator, though, is getting extreme, and we're very extreme on the daily chart. The force index is still positive. It's green and advancing. We are showing an improvement here with the money flow indicator, and we're also going up on the week, so we're above the zero line here and going back 50 weeks. Now, we could go higher than where we're at right now, but sometimes this ended up marking some kind of a top or some kind of an extreme positive reading. But you can see there's other times when we went way beyond that. The RSI based on 14 weeks is above 50 and advancing. That's positive. The weekly special K chart is turning back up, but it's got quite a ways to go before it's going to cross above the red line. We're still positive on the daily chart. And then with our Stochk RSI, we're extreme on the daily charts. We're also extreme on the weekly chart. The Williams percent are also extreme on both the daily chart and weekly chart. We're getting extreme now with the ultimate oscillator, both on the daily chart and weekly chart. The green line is still on top of the vortex, and that's being confirmed by what we're seeing on the daily chart. The Copic curve is starting to turn positive, and we're getting close to turning positive on the daily chart. And when we're crossing above this midpoint, that is usually a good sign. Looking at our different support and resistance levels, we're not really dealing with anything other than this previous test that the market may try to give to the all-time high right here, but we're not really seeing any support levels very close. Our different charts, when we look at all of the different trends, the Heiken Ashi is positive, the Kagi chart is positive, the Renko is positive, and the three-line break is positive. Seeing that same thing on the daily charts. The ease of movement is looking better. We're above zero and advancing. And we did have a couple of new X's drawn in here. We're still working off of a double top breakout on November 20th. That's the same signal that we're seeing on the daily charts, or the daily point and figure chart. We are positive when we look at the Elder Impulse system for the S&P 500 with the green bars. We're also positive with the parabolic SAR. We're also positive with both of these charts on the daily versions. And the PPO studies, longer term, we're going up. Intermediate terms going up. The short term is pretty much flat, but showing some improvement. And then I changed the name of this. What I do is I go through the PowerPoint for Monday's video, and I just pick out, oh, these are kind of cool charts, but they're not necessarily all daily charts. So I felt I should change that. This is a little bit of a concern. We might be going through an environmental change in the market. The market behaves differently in a rising interest rate environment, and then it switches over and behaves differently in a falling interest rate environment. And we haven't been seeing growth really outperforming value here. So for right now, that's a bit of a concern as we try to figure out just what environment we're going into. And then the skew index is generating a signal now. We're up into this red area, but as I usually point out, that doesn't necessarily mean we've topped or bottomed, or we may end up continuing here. When you look at other times when this happened, we see pretty much a smorgasbord of events that happened after that. The transports have been a bit of a concern. Where the Dow is breaking out above this previous high, we're not seeing that with the transports, even though they were up pretty good in Friday's session. As interest rates go down, utilities will be going down as well. And the transports are still underperforming the Dow. In a stronger environment, we want to see the transports outperforming. Where the Dow itself, man, it's just looking pretty positive on the daily chart right now. The NASDAQ 100 back up here to this R1 level, back to testing these all-time highs here and setting new all-time highs along the way. So this is still looking positive. And here's the weekly chart of the QQQs, which is the NASDAQ 100. We didn't break out above this, but we did set a new all-time high, at least this past week. And we broke above this one resistance level with the small caps. We broke above another resistance level, but now we're starting to come back down. Are we going to get faked out again, or are we going to see some follow-through strength for the small caps? We are setting new all-time highs with the FANG index. These are more the mega cap companies. And when we look at the broad market, we're now focused on December, where we're up 80% of the time, and the return is typically 1.7%. We look at just a plain vanilla chart of the S&P, which is breaking out above this previous high. With the mid caps, we're kind of right at this previous high, and we're a little bit above it here with the small caps. So we are seeing some improvement. When we look at the Dow, we're still in an uptrend. The NASDAQ is in an uptrend. The NASDAQ 100 is in an uptrend. The mid caps are still in a downtrend, but if we stay above both of these lines, we might see a golden cross. And the small caps, too, are also showing a little bit of an improvement here. The NYSE, after turning more negative, is now switching to look more positive. All stocks continue to be in an uptrend. The 30 biggest software companies, not quite at the golden cross here yet, but we are seeing some improvement. The FANG index, as I showed on the daily chart, we're breaking out and setting new all-time highs. ARC is also showing some improvement. It ended up being up almost 4% on the week, and we're getting back up to the 50 level. I know it's not the 160 level that some of you ended up buying this in at the time, but at least this is starting to show some improvement. When we look at the banks, we are seeing some improvement. You can see the bar chart really showing some improvement. We're getting overextended with the RSI, but on a momentum basis, we are still positive. And then looking at the whether money is going in or out of banks, we're still showing a negative result as folks are tending to take out more money than they're putting in. So we look at just a blanket chart of Dow theory, where we're breaking out and setting a new all-time high with the Dow, where it's not confirmed yet by the transports. And traditional Dow theory says these need to confirm each other, not necessarily on the same day, but within the same basic time frame. So if we can see some more strength with the transports, that would really help things a lot. And we did see a little bit of an improvement weekly with the utilities. Then some broad market measures. We're seeing commodities really starting to go down, even though they're still in an uptrend. Oil is continuing to go down. Haven't been following it that close because it really spiked up when things exploded over in the Middle East. Now they're starting to come back down, but I still look at the price every day. Copper might be showing some signs of improvement. We are still in an uptrend on the weekly chart. We're still fighting against a downtrend on the daily chart. And the dollar has been declining, and that's typically what we will see if we're switching back to a more positive stock environment. Gold, after breaking out, has been coming back down, even though it's still in a longer-term uptrend. Silver continues to be in a longer-term downtrend and has also been pulling back. Looking at bonds, where we're still in a downtrend with the total bond ETF, but we did show a bit of a breakout. So this is really showing some improvement. And stocks continue to outperform bonds on the monthly chart, even though this is rolling over. And this I've been pointing out in the daily videos because we don't usually see this. This is the 1 month yield, and we subtract the 3 month yield, and we're getting a positive result. The shorter term yield is higher than the 3 month yield. And that doesn't make sense. That's like an inverted, very short-term yield curve. And sometimes that means weird things are happening. We're just not quite sure what that means right now. Here's a look at the daily chart of the yields, and you can see that overall they have been declining. Here's a weekly chart internationally where we're dropping with the US and UK rates. We're dropping in Germany. We're even dropping slightly in Japan. Then some relative studies. We first look at the intermarket analysis chart going back to the beginning of the year. Stocks are doing the best, followed by gold, the dollar, and now bonds have actually turned positive. Woohoo! Where energy has now dropped down to negative on the year. Going back to the all-time high, where we still have oil. I should have said oil on the previous chart. That's still doing the best, followed by the dollar and then gold. And stocks are just possibly getting ready to turn over positive, where bonds based on price are still negative. When we look at the NASDAQ 100 to S&P 500 ratio, this is still going up, meaning the NASDAQ 100 is outperforming. We're seeing a little bit of a slip down here with the S&P 100 to S&P 500, but this is still in a longer-term uptrend. And this is the other area of concern, even longer term. We're seeing growth not really outperforming value. It's actually starting to pull back on a weekly chart. We're still in a longer-term uptrend, but we want to see growth start to do better. When we look at gold, it's really underperforming the S&P and continues to be in a downtrend with this ratio. And we're also kind of coming back up to this trend line here with the gold to US dollar ratio. And bonds on a shorter term basis are continuing to underperform stocks, and the low volatility stocks are now breaking out. We found some support in here. Now we're starting to break down, showing that low volatility stocks are underperforming the S&P. Discretionary is showing some improvement and now outperforming staples. And energy is now continuing to underperform tech with this ratio. Then some longer term charts, the NYSE breadth thrust. This is still on the books. It was generated October of 2022, and we're now finally possibly seeing some follow through to this. And then we had two ZWAG NYSE breadth thrust triggers that happened within the same year. And this is a very rare event. This is longer term positive. The Zohorchak did come back up to 0, where it had dropped down to -6. So this is showing some improvement. We want to see it go back up if we're turning more positive, but at least it's going back up for right now. And then when we look at the trend line going all the way back to the 87 crash, we're starting to break above this trend line now. I know a lot of the doom and gloomers out there, they were just salivating looking at this chart thinking we're just going to hit this and then go in the toilet after that. Well, that hasn't quite happened yet. And then here's just a shrunken version of that same chart where we are starting to break above this trend line. The question is, can we stay above it? And if so, are we going to start to break above that? We're also coming right up to the underside of this chart with the NASDAQ 100. This may end up providing overhead resistance. We want to break on through to the other side, as Jim Morrison would say. And then when we look at the NASDAQ 100 to Dow ratio, we're actually chopping around more or less sideways without getting up to this previous all-time high. When we look at the Qs and then do a ratio with the small caps, we are declining just a little bit here. And then we're seeing some improvement with the cumulative new highs, new lows for the NASDAQ. It's probably really hard to see. You might need a magnifying glass or a super zoom tool on your computer, but we're just barely turning back up. And we haven't seen that in quite a while, because we're going above 0 when we look at the raw score for the new highs, new lows. We want to see this turn and go back up. That would turn things more positive after declining for several years. Then we're not quite sure how to interpret this chart. We came back to the level that we were at back in 2007 and started to go above it. Now we're starting to roll over. When this happened back in 2007, the great financial crisis happened after that. Is that what's going to happen this time? Maybe. Or is this just coming back down after having a good run up and is not necessarily going to forewarn us that we're going into some kind of financial crisis? We have to leave it open-ended right now. We just want to be aware of this chart. So what's our outlook then? And this is just for Monday's session. We're getting closer to Christmas now, so we might see things going into more holiday mode, meaning not as much volume. And then earnings as they are released. The technicals are still positive on the daily charts, but we are overbought and we've been breaking out of the range lately. We will only get the NAHB Housing Market Index in Monday's session, and then we want to keep an eye on the whole list of geopolitical events. Here's the economic calendar for the upcoming week, where there's a lot of important reports coming out, like LEI, the third estimate for GDP. But the big one is going to be the other inflation report, the PCE prices. We're also going to get consumer sentiment, which can be influential. Then looking at seasonality, we're now into the week after options expiration, where we're up 64.3% of the time and we're down 35.7% of the time. Just looking at December 18th, where we're neutral to negative, where we're neutral to positive with the S&P and NASDAQ. And we're wondering, is the January effect going to continue? This is when the small caps outperform the large caps. And looking at Monday's session, we'll be on the 12th trading day of the month, where we do see a little bit of positive seasonality during a pre-election year. Now, a lot of these other charts are just going to kind of show you the same thing. The Carson Research thinks that now we've bottomed now in the month of December, and we will continue to go up for the rest of the year. We tend to be positive on Monday. That tends to be the most positive day. Friday is number 2, followed by Thursday, where Tuesday and Wednesday tend to be negative. And we're also possibly seeing positive seasonality for the S&P 500 on this chart, also for the S&P on this chart. I did update this one. We're actually starting to outperform seasonality a little bit with this updated chart. And we're also looking positive seasonally, unless you go into the very end of the year where sometimes we see some weakness. We think we're beyond this downward slope with the Carson research and then see positive seasonality for the rest of the month. And then we have the equity clock chart, which never really showed our decline here before we go back into positive seasonality. So on a historical basis, there's real room for seasonality to remain positive. Now, doesn't necessarily mean that's what's going to happen, but we do have history on our side right now. When we look at the stock traders almanac statistics for the NASDAQ, we also see positive seasonality as well as positive seasonality for the S&P. Here's another new chart that I got from Isabel Nutt blog charts, where we're wondering, here's 1982, if any of you were around then, that's when we finally bottomed out. And you can see there's kind of a parallel with 2023. And then we started what ended up being a massive bull market that went on for decades. We're wondering, are we going to be able to match that this time? And I'll try to update this chart as it's updated and I have availability to it. So our scenarios, we're not going with the down scenario in our daily look at things. If anything, we're still going with the up scenario, even though we are overbought. And we're wondering, is there some kind of a blow off top that might be developing? Not saying that's going to happen, but it has happened before when things become so irrationally exuberant that people are just throwing their money into the market and they don't care about price. They just want to be involved. And that's usually when things end up being a blow off top. And we're a little bit concerned with our trend now because both our short and intermediate term ADX charts, not only are the indicators above 40, the green lines are also above 40. And we haven't seen those readings in a long time. So our warning signs, it's kind of a short list right now. We are concerned about growth not participating. I could have also included transports on here. The Copic curve is still negative, but in the next day or so, it could actually cross over positive. And we're still dealing with longer term downtrends with the Russell, small caps, and mid caps. We have a pretty long list. Oh, this is the longer term list here, where we might be signaling a top. We haven't decisively broken above those weekly trend lines on the S&P and NASDAQ 100. The cumulative new highs and new lows, they're still negative, but possibly improving. But we're going to have to see some long-term improvement before we switch our stance on that. And our 3-month yield, it's above where it was back in 2007, and it is starting to decline. We don't know if that's going to be a signal. We just want to watch it for now. And then earnings as they are released. The positive signs, this is the list that's getting pretty long. Our daily special K chart is positive, where our weekly chart is negative. The equity put call ratio based on 5 periods as well as 253 periods, they're going down, and that's positive for the market. The risk on posture has been showing some improvement now, and our oscillators are turning more positive. We're looking a lot better on a momentum basis. When we look at the parabolic SAR and the vortex, those charts are positive. The bullish percent index, it is above 50, but unfortunately now it's also above 70. So it's starting to get extreme. The Zohorchak method is showing some improvement. And we're a little bit concerned here with the small and mid-cap growth, just like we are for the S&P. But mid-cap growth is holding up a little better. I didn't show the chart here, but I did look at that. But it's pretty much chopping sideways now. The financial sector is seeing a lot more of an improvement, and a longer-term 50-period moving average study of the new highs and new lows for the S&P, that is still positive and getting more positive. We did have 2 Zwag NYSE breadth thrusts that were generated over the past year. We saw one last spring, and then we saw one, I think it was October. And seasonally and historically, December's the 3rd best month of the year. Are we starting to experience, you can probably already say yes, we have experienced the January effect. The question now is it going to continue? And our longer term positive seasonality and setups, those are still remaining in the background. The S&P is still above the downtrend channel upper line, and I'll show that in the deep dive video. So our conclusion for Monday's session, we are overbought. We have been breaking out with price, but we're wondering, is it getting a little out of hand with a blow off top? We are mostly looking at the short term right now, where we're becoming quite extreme in the intermediate term. We're just a little bit extreme in the long term. Thank you. I really hope you found this helpful. I hope you have a very good weekend, and I will talk to you in the next video.